Hey, we're back with the Holy Macro Show. I told you guys these would be kind of pop-ups going forward for a little while. Being on schedule is going to be tough for me for probably another 3 weeks. But I will try to pop in from time to time and say hi and talk to you guys about markets. And so today, I wanted to talk to you about what's going on in the market. Or this is the Holy Macro Show, but this is on Tuesday, or sorry, Wednesday. So we're just kind of impromptu jumping on here to talk to you guys about markets. I feel like Kashop's a great person to talk to today, considering we've really been laying out the macro framework really well. And like I don't usually talk out my great calls or any of those things much, but it's like, you and I have really kind of laid it out. And you even more so with the US stock market. So, do you want to elaborate on the Minsky moment for a second? Because, we talked about that a little bit the other week, and now we've kind of really seen it show up in the market. Maybe it's bottoming out, maybe we're headed lower. I don't know, but that was one of the quickest crashes that we've seen in this market on a rate of change basis. So, what are you thinking about this, Kashop?
Sure. So, coming into the year, a lot of similarities to 2020 were present. If you recall, that was a market where it just looked like it's going to go straight up. And then we had the coronavirus scare and everything. So, at that point, it was easy to blame everything on the virus and the panic and everything that ensued. In this situation, everyone is blaming it on the surprise tariffs. Whereas if you listen to Trump on the campaign trail at all, like just one speech, he told you that tariffs are going to be his thing. And everyone did listen. So, was this really because of tariffs or was it because of something else in the market? So, the Minsky movement actually talks about how these stresses build up, and they build up because after a recession, you have low debt and people are scared of lending, people are scared of borrowing. So, borrowing, lending, it's all kept to a very small level. Maybe you need a working capital loan, maybe you need something that you just need to tide over for the next 3 months, and you take more of producer loans than consumer loans. And then slowly, as the economy improves, interest rates come down, the fear dissipates, and you get a real bull market. Now during this bull market, people make loans they shouldn't have, but they get repaid anyway just because the economy is so strong. Maybe you company expands production and they don't really know if they have the end demand for it, but that demand comes up in the late stage of the cycle because there's just excess ordering, excess inventory. Everyone is just bullish and looking forward to the future. And then there comes a point where the only way to service debt is by issuing more debt. That in fact the only way to even pay the interest on the debt is by issuing new debt. So that's the Ponzi phase of the cycle, and that's what Hyman Minsky, who was an economist, so that's what he called it. And when you get to the stage is when all the stresses which have been building up, they really start to surface. So whether it was tariffs, whether it was the coronavirus or any external factor, that was just the catalyst. The conditions were already in place. It's like, why do forest fires happen? They don't happen just because there has been no rain. They happen because the kindling builds up and then one spark sets it off. Now, do you go looking for the spark and trying to put it out? Or do you just look at the forest and say, this is going to blow, this is unstable? So the Minsky moment, the Minsky hypothesis gives you a framework where you can look at an economy and you can say, this is unstable. So you don't need to go looking for a spark. You just need to know this is unstable. I need to stay away. Now, why is gold going up so much? Because gold, if you look at when gold bottomed, it was October 2023. And October to November, December, it didn't do much. And then it started going straight up. And it's been going straight up for 16 months now without a break. Now, why is that? Because gold saw all this stress building. And now that the stress has become a little more apparent, gold is still seeing more stress in the future, which is why you have this, somewhat parabolic move on the daily chart. Now, if you zoom out and look at where gold is, it is nowhere close to topping out. But if you look at a daily chart, or like nowadays everyone trades the extremely short term horizon. So you look at an hourly chart and then people are like, oh, this has gone up too much, it's going to stop. And if you actually had, like you and I, we have been in Bitcoin since 2015, 2016. So we have seen these parabolic moves, and we have seen how wrong it is to bet against these parabolic moves. So 2017 cycle, Bitcoin went from thousands straight up to 20,000 without a correction. It was just straight up, and there was no point where you could say this is where the parabolic move ends. And after it ended, it became obvious. So I think, you know, with gold, everyone looks at it, oh, it's going parabolic. Everyone looks at the dollar and they're like, Trump has to do something here. But whatever it is, the market is too strong. It is too powerful. It is more powerful than all of us. And I think that's what gold is showing us. Like, everyone has a theory and everyone thinks, okay, this has to end here, this has to end here. You're all guessing. What actually is apparent is this is an extremely powerful uptrend, which is supported by strong fundamental factors.
No, I agree, and that's the thing that when we're looking at gold, I think it's also the environment, and for my trading, I always go back to environment, like what's going on that would make gold do well. And it's the uncertainty right now. We don't know what is happening from day to day in the United States, especially with our president. We don't know what globally is happening behind the scenes. We don't know what China is really doing. We do know that they're buying a lot of gold. But we just don't know. And when you're in that type of environment, like stocks hate uncertainty, gold loves uncertainty. It's something that you always have to understand as a trader. So if you're, in the market and seeing this type of move in gold, like it isn't the most insane thing in the world. It has happened in history a bunch of times, actually. And if you go all the way back to when they started using gold, I'm sure it's happened, 50, 60 times in history. In the United States, it's happened 4 times. So basically looking at this and going, okay, we're in a commodity cycle. Gold is really the one that always kind of leads the way. I think that becomes a situation that's just apparent right now. Like gold is just leading the way. Gold miners are looking fantastic. Whether you're buying the small cap ones, the juniors, or you're buying the large cap names, like whatever it is, like you're in that space and you're winning because you're in that space. I got a bunch of hits when basically the market's down. I don't know, it was down like 20%, almost 20% year to date. It didn't quite hit 20, but it was almost 20% year to date at one point. And I had a bunch of people hit me up like, oh, look at silver down, it was down 7% in a day or something. And it was just like, man, when you look at these, number one, that was a huge sell-off. And that's a liquidity event. And that somebody probably blew up in the middle of that. Like there was probably some fund that blew up, needed money, and started selling whatever they could to cover margin calls or whatever. So that does happen during those times, and you see these sell-offs just kind of across the board in a blanket sell-off. But the thing that goes down the least is usually the one that leads on the way back up. And I kept saying that the other week when this was all happening, and I don't think anybody took that seriously. And what fell the least? Well, it was gold. It was gold miners. It was even silver fell less than just about everything else. So, you still want to be in those areas. And not to mention, like, if you did kind of think about that as a buy opportunity or some sort of like silver hitting the top, it hit the bottom of the range. Gold miners hit the bottom of the range. Gold didn't really pull back that much. I was about to say gold hit the bottom of the range, but no, gold barely pulled back. And so when we're looking at these type of markets and these scenarios, like you have to just understand like where people are putting their money. And right now it's very obvious that they're putting their money into gold and out of dollars at the moment. They're just out of dollars. They're basically selling the dollar heavily. You just as well as me, when you're in those sell-off situations, you see people go to one or two things, or three things actually. It's either gold, they go to the dollar, or they go to bonds. 3 things. This time they decided they were just going to completely continue to sell dollars, which we haven't seen in many years. They did buy bonds for a little while, and then that was over very quickly. That was short-lived. And then the money just went right back into gold. So it was, and that's also a fundamental thing where you're seeing countries actually selling. Like we saw a huge outflow in treasuries last month. And so seeing that huge outflow in treasuries last month from China and all these other countries at the moment, and where did they put all their money? Well, they probably put it into gold. So it's kind of very apparent to see where people want to put their money right now and where it's treated the best. It's the reason why we do ride trends in these cycles, is because where money's treated the best is where it's going to flow. And over time, yes, that will change. But at the moment, you don't bet against something that's just ripping higher every single day. Like, it's really, really tough to bet against that. And also the miners look great. You have a whole sector to pick stocks and whatever you want in. I think that's where you want to be right now still.
So, you bring up an interesting point. Like you and I, we have enough gray hair, and we probably talked about this probably 8, 9 years ago. So,
Mm.
2012, there was this kind of logic that, I mean, the EU zone had just had a crisis, and Iceland was in the news, Greece was in the news. Everything looked kind of panicky. And that was a time when every time there was a market sell off, the Japanese yen would get bid up. And we remember thinking it was insane. Like, here is a country which has a phenomenal debt load, like something like 200 to 50% of GDP. And then they elected a president who came out with three arrows. And one of the arrows, no surprise, was more money printing. And every time there was a correction in the market, people went to Japan as a safe haven. And it made no sense.
It's
But
called
that was a
Abenomics, right? Abenomics
yeah,
or
yeah.
something like that.
Abenomics,
Yeah.
three
Yeah.
arrows. One arrow was money printing, one was structural reform. I forget what the third arrow was, but and it was just insane. So there were these European banks which were selling 10-year options, betting on the yen going to 160, 200. I remember some fund managers taking those bets. And but the rest of the world, every time there was a sell-off, they bought the yen. Why? No clue. And that trend lasted a really long time. Japan was borrowing at a lower interest rate than the US, and that still did not pressure the currency. Why? No clue. It just went on for a really long time. And that's the thing with these trends. And forget about all that. The time right after the PEGS crisis, European yields started to go down, and German bonds went negative somewhere around 2015 or so. And there was a time where Nestle issued actual bonds with a negative yield, meaning at issuance, you are guaranteed to get back lower than you put in, and people still bought those bonds. Now, why did they do that? I think it was Austria which issued a 100-year bond, and it's crazy. Like, I think Argentina did the same thing. Now, if you understand how bond math works, you know that there is no way those investors are going to get paid back anything close to what they put in. But the market didn't care, and that trend lasted a really, really long time, even though it shouldn't have. Now, when you look at what's happening with the dollar or what's happening with gold, the fundamentals are actually aligned with the price action. So if you have a trend where both the fundamentals and the price action, it all makes sense. How long can this go on? Well, it can go on for a really long time. It can, like what happened in the 70s. So from 1976 to 79, you had a major bull market which was supported by the fundamentals, and then things changed. So, I would not discount the move in the dollar. I would not look to fade it. I would not discount this move in gold. I would not look to short it. It's strength. It's the kind of strength which shows something has a long lasting power. And sure, you may, trade it counter cyclically and scalp a little bit, but the big move is like what Jesse Livermore said: find the trend and just ride it. And I think that's pretty much what investors need to do. It's a very easy trade to take as well.
Yeah, I think generally, like, that's just the key. Like, and it's hard to do because, like, there's so many shakeouts. I mean, think about gold. And this is a good thing to kind of just talk about here. If we talk about gold, crap. You know what? I need to bring up a chart here because this is actually a perfect time to kind of give a good lesson on what's kind of happening in the gold market. So, but if you're thinking about gold, at Kashop, go ahead for a second, and I'll come back with this. I want to bring up a chart here.
Sure. So, and you mentioned silver having a 7% move. And by the way, that was a period where the natural gas did absolutely nothing. It was just flat. So here is a commodity which is volatile on most days, where if it moves 10%, that's hardly news. And when everything is moving 10% and this commodity is just like, hey, I'm just going to hang out here, do nothing, and just chill over here for a while. And it was very weird to see that. But that's natural gas for you, right? Like
It's
when you
natural
expect
gas.
it.
Yeah, it's natural gas is always the one that's like just laughable. So, but natural gas is like it's the most uncorrelated thing I've ever traded. I will always trade it in the portfolio long and short because you can get so many trends out of this thing. And, the market could be doing whatever. The market could be skyrocketing higher, natural gas will do whatever it's going to do. The market could be dropping and crashing. Natural gas could be straight up for the next 6 months. You just never know. And for me, I like things like that because it uncorrelates my own returns. So looking at this gold thing, and this is what we were talking about earlier, gold breakouts. So what we were talking about here, I said it's hard to catch trends and really ride them, but it's not hard as well. So the reason why I said it's hard is because you'll have these false breakout signals. Like for example, let's say you're running a 100-day high signal. It would have probably given you a signal here. I don't have the indicator on the chart right now, so forgive me if I'm wrong. But I'm pretty sure it would have given you a signal right here to go long. That was wrong. You got another one probably here at some point. That was also wrong. And then you finally got the last one, which was completely right and started that trend. So you were wrong a couple times to be right in a huge way. And I think that's a good lesson in trading. And the reason why I want to just kind of stop everything and bring that up is because this is how every good trade for myself always works. There's never the first try where it just goes great and you're just riding. Like let's say I bought down here and I sold all the way up here perfectly, and there was no consolidation. That would be great, but that's just not how trading works. It's a probably chopped up here once and then we got a good trend, probably chopped up here obviously, and then got a good trend. And like Kashop said, like sometimes when you're in these trends, and it's also understanding what type of environment we're in. Right now is a great environment for gold. Between the central bank buying, between monetary policy, between liquidity, like everything is set up for gold to go higher and more people to get involved in gold. Not to mention the global demand for gold at the moment, the global supply of gold. Like it literally, like supply to me on gold doesn't matter that much, but at the moment it's very interesting because there's so much demand. People are running out of it in certain areas, whether it's for COMEX, whether it's for the LME, whatever it is. The physical deliveries of gold have been so high that some of these exchanges are running out of it. That's pretty interesting. Not to mention, Kashop and I have highlighted in the United States, like we're selling it at Costco now, and I just got a Costco account pretty recently, and if you go in there, you see like there is gold bars there. So there's straight gold bars. You could buy 10 ounces, you could buy 1 ounce, whatever you want to do. I mean, it's really interesting, but that's a huge change, and it's a fundamental change. So once again, it's don't fade a trend. I know that looks parabolic to people, and I really hate that term because there's no real way to say like this isn't parabolic. When I first wrote about gold and how I thought this was a great breakout and could continue much higher, I was talking to people here. People were getting bearish here and going, "Oh my gosh, this is the end of that trend. It's parabolic." And I'm just telling people like, this. I actually did a story from Bitcoin in 2017, so I'm glad you brought up the 2015 period because 2015, we get long Bitcoin. We have this crazy run for until 2017 where it peaked out around 20,000. And during that time, I remember like talking about it to friends and people be like, "You're an idiot. That doesn't do anything. It's not real money. You can't buy anything with it," and so on. Nobody really understood the trend in it at the moment. And for me, it was never I'm betting on the future. I'm betting on this. It was, hey, there's a great uptrend. It's strong. I want to be involved in it. But once we got above 10,000 in Bitcoin, people started to call me and be like, "Hey, this is awesome. Why aren't you, you should buy this one." And everybody in the world was buying those ICOs that were just going to zero. I mean, it was wild. Like it was way crazier than the last Bitcoin run. Like, yeah, we saw the meme stock phase, or the meme coin phase. Yeah, we saw the Hawk Girl and Trump coin and all this stuff. Sure, like that did happen, but back then those ICOs were rampant. They were everywhere. Everybody was trying to get involved in them. And then I had a person call me and say, "Hey, Litecoin is going to be worth more than Bitcoin." And I just did the math, and I said, mathematically, that would be tough. Litecoin would have to be worth this much, have a market cap, and I just gave him the math. And he told me he was going to kill me. He was going to drive to my house and shoot me in the head. And like, I mean, I'm not even kidding. Like, this guy's a very scary guy. Like, he's if you can picture a Slayer concert and a mosh pit, the picture of him, like, there's a picture of him actually of this. I'm not going to share it because it's actually of a he's a friend of mine in a way. I haven't talked to him since then actually, but we grew up. I knew him growing up, and there's a picture of him in a mosh pit, and he's like got his arms up, and like everybody's probably like 10-15 feet away from him at a Slayer show. Now that's crazy for a mosh pit, because a mosh pit, like at a Slayer show especially, like nobody's really afraid of anybody, but this dude's huge. He's literally like he's probably 6'8", 6'9", 350 pounds, like just a monstrous dude. So like, it was pretty scary, but that's the level that we had at the time. And I remember, like, I'll always remember this one because my son was involved, and I grabbed him and I said, "Hey, I'm gonna sell my position here." And I never do that. Like, I never sell without a sell signal, but I sold half of my position there, and I brought him in because I was like, this is what a mania looks like. And I remember trying to like teach him that, and hopefully he remembers that to this day. But still, that's what a mania looks like. This is nobody still believes this is happening. Everybody hates this. They don't think it's sustainable. Gold, you remember Peter Brandt put out something that gold always stops before the even number, so it's not going to get past 3,000. All this crap over and over again was going out, and then you have the situation now. It's above 3,000. It's still in a very stable uptrend. I just wouldn't bet against it. It's not that I think it can go much higher. I'm just going to admit completely, I have no idea where this ends. It can end, but I don't see the mania phase that I think people are talking about yet.
So 2016, we saw the mania phase. Gold went from $1,100 to something like 1,300, and we saw a mania phase. So there was a point where you go onto Kitco, every single day you would have news of a new gold company getting launched, which had some moose pasture in some corner of Brazil or Madagascar or Kenya or some place with the promoter shiny share structure, and they would give you warrants. You'll get 2-year out of the money warrants, and those warrants could go to the moon, and you had to buy those stocks. Or there was this ETF called NUGT. Everyone was trading that ETF. It was a 3x leveraged ETF on the gold miners, and it became so popular. There was one more which was launched called JNUG, which is a 3x leveraged ETF on the gold junior miners. And it just went crazy, and everyone was trading it. And then they got options on those ETFs, and that was a mania. And if you remember 2020, 21, so 2020, I think it was October or November sometime that Bitcoin broke 20,000, which was the previous all-time high. By December, it had gone to 26. And everyone thought, okay, come January 1st, everyone who's held Bitcoin is going to take profits so that, they don't have to book their capital gains. So after January, it's not going to run. And I think Jan 2021, it was a slight down month, maybe 3% or something. And then it went straight to 64K. Like, it just didn't stop. It went straight to 64K. And Ethereum, I think that was a time when it went from like $300 to $4,000 or something. And that was the number 2 crypto. And it just went straight up. So, when you see these powerful trends taking shape, even if you are a little late to the party, why would you want to fade these trends? Maybe fading these trends works, and maybe gold dips tomorrow and you feel like a genius for saying, ha, I took the opposite of Kashyap's view and I shorted gold and I made this much money. But sure, if that's your time frame, go ahead and do that. But if you take a 1-year time frame or a 2-year time frame and you see all these powerful forces building up for gold, why would you short it? It makes absolute sense to just get long and ride the trend. because you know that in a year or two, your entry price isn't really going to matter all that much.
Yeah, exactly. And that's kind of, and by the way, guys, I've told some of you guys some lights are going to bother me, so I'm sorry if I'm sitting in the dark some days. You know, we all as traders, I think it's a normal feeling to always, especially when you're making money in something. Especially when you're making money in something, you always feel like it's topping out. And this is why it's always important to understand where you're getting out before you get in. But you feel like you're in this, let's say you're a person who's in this trend in gold and you're just been holding on to it, and you're like, let's say you have no strategy, nothing, and you've held on to it and you've made a ton of money. Every day is going to feel like it's the end of the world until you just understand something simple. Hey, here's my trailing stop. Hey, here's my exit signal. Here's my fundamental exit. Whatever it is, have a reason to get out before you get in. And that can change over time if you're fundamental, but if you're technical and you're systematic in some way, like, I think that's going to help you because it will make you not make stupid decisions. Because generally, like, you're never going, there's no system, no strategy that's ever going to get you in at the bottom and take you out perfectly at the top. There's ones that can help you catch the meat in the middle. And really, it's like, if you look at my stop loss for gold, you know, like, let's say it's 2,800. I know it's somewhere around 2,800 right now. You know, that's just, hey, I'm not trying to catch the top. Like, if I'm trying to catch the top, that would mean I'd sell today, or I'd have sold 3 weeks ago, or I'd have sold 5 weeks ago. And the market, and it would have kept going up, and I would have lost money there. This kind of makes it so, okay, when something fundamentally changes in the trend, I will be out of this trade. And that's all you can do as a trader. But, you know, all these things with gold, it's a big dollar story here this year, you know, and sometimes gold and the dollar, they can go together, they can go against each other, whatever it is. But right now, it's definitely a story where we're seeing these currencies against the dollar do well, and we're also seeing gold do very well. Swiss franc hit 10-year highs the other day. That's very interesting. You know, that's something that we haven't seen in a long time. And this is a chart, you know, a lot of people don't trade currencies anymore. So people don't look at the currencies. But once again, this is a significant thing because this can tell you what the dollar could look like pretty soon. Obviously, this is inverse to the dollar chart that we just had up, because I actually use these all in futures. So I actually traded CHF USD. But this being inverse might tell you that, okay, well, the dollar, if we go back to the dollar chart, might break down pretty soon. And so if that breaks down, we're in another situation here, which is now what happens to gold if we're just trending down here. Let's say we really break down. Let's say we start to head to 96, 94, you know, like, what does the market look like at that point? And I just think it's just the whole idea with this year is to continue to stay in the international equities, continue to look at gold, silver, miners, take the commodity trades as they come. Don't go all in on them, but take them as they come and go from there, because we're in some sort of environment which is either stagflationary, deflationary, disinflationary, somewhere in between that at the moment. So that makes it a very dynamic environment. But the one thing that does well in all of the environments I just listed is gold. And that's the reason why we're seeing it really outperform. So, Kashab, we'll talk about the miners for a bit, and then we'll hop off. You know, this has been one of your really great calls, was talking about the miners. You have much better picks than I do. I just have some junior names, some major names, and I'm sure I stole some names from you. But what are you thinking about the miners here? Do you think this is going to pull back? You know, do you think it comes back to support sometime soon? Is there names that you really like in here? What are you thinking about the gold miner complex?
Sure. So if you look at the GDX, you look at the big names, and I'm starting to get a little concerned about the valuation. And that's like, take a big miner like AEM, which is the highest market cap gold miner right now. It's something around 5x sales. And that's the kind of valuation you would typically give a tech stock. Now, yes, Agnico has absolutely fantastic assets. And if we have, let's say, a 10-year bull market, why shouldn't gold miners trade like tech stocks? You know, instead of revenue growth, you have commodity price growth, which gives you the revenue growth the same way. So, yes, it can happen. But It's something that I haven't seen all that much in my experience. Like you go back to 1920s during the Great Depression, the miners had crazy valuations and they did very well because costs were going down. And then you look at periods like the 70s and you look at periods like the 90s, yes, you will get these cycles. But at the same time, the reason I'm able to tell you all these examples is because those instances are rare. So if you're buying gold miners at this valuation, you really should know what you're buying and you should be prepared for the corrections. So if Agnico corrects from 5x sales to 4x sales, would you still hold on to the stock? Because do you really believe it deserves that premium valuation? If the answer is yes, then you buy it. And the other thing to watch out for, if you're buying the index, the ETFs, that's fine. If you're buying the individual stocks, you really have to look out for whether companies have hedged protection or not. So what happens is, so the best example of this is a company called Anglo Gold in the 1990s. So what they did was they forward sold a bunch of their gold production, which means they shorted gold and used the funds to build a mine. And problem was once they built the mine, costs went up, the gold price went up, they lost money on the shorts, and it was a big mess for them. So in effect, what happened was they had to sell at the old price even though the cost had gone up. So they didn't realize any of the upside of gold. In fact, they lost out. And it's the same in the oil complex. So 2022, that was the time when oil did extremely well, and there was this refinery stock called Vertex Energy, VTNR. Turns out they had put on a bunch of hedges, and even though the crack spread blew up, which means refiners make heavy margins, these guys lost so much money they went bankrupt. And just a few days ago, Bellevue Gold, which is listed on the Australian exchange, and full disclosure, I'm a shareholder, I did not see this coming. So what happened was they had to close out their hedges for a loss, but now that they have done it, they are on solid footing. And this is what you see happen over and over again, where miners do not expect these sudden up moves and they get caught on the hedges. So if you're buying individual miners, be wary of the hedge structure and just look to see whether they are actually going to realize the upside or they're going to lose money on those hedges. So that's the other thing to be watchful for. Or like Agnico, you buy miners which do not have a policy of hedging. So that way, gold falls, then you're on the hook. But if it goes up, then you are in for the full ride. So you really, or you can just structure your portfolio so that you have a mix of all of this, so that no matter what happens in the short term, you will have less volatility at your portfolio level, and that makes it easy for you to ride the pullbacks and get to the long-term gains.
No, I love that. Let's end it there. And guys, I will see you sporadically over the next couple weeks. And we'll see you guys soon.
Bye, everyone. Thanks, Jason.
Thank you.